Okay, investors, I was born in 1965, and classic rock is something I love. 1970s, 1980s rock bands, but there's a special place in my heart for Led Zeppelin. Yes, the iconic rock band led by Robert Plant, Jimmy Page, John Bonham, and John Paul Jones. Nope, not the retired legendary trader Paul Tudor Jones, who we called out many times the last 5 years for being chronically misguided in the direction and timing of his stock market calls. So, Paul Tudor Jones has said that we were in late 1999 replicating the near end of the dot-com bubble. Investors, my view, I doubt that's the case. I doubt we're in the ninth inning as he suggested, and the party is good enough to hang around, but one should be looking quickly for the exits. We've covered this material a couple times over the last 6 months. Lately, there's been quite a lot of negative market talk about the market being overbought and breadth deteriorating, or many bears discussing a dire, their term, reduction in bank liquidity. I mean, every few weeks the bears have tried to latch on to these and other so-called critical topics to explain why the end is near for this bull market and for the V-bottom rally. Even though I can't find any of them who said buy 7 months ago at 5,100 on the S&P 500 during the Trump tariff tantrum. This rally has left most bears and many hesitant investors dazed and confused. Our team has been here since mid-April with a whole lot of love for our clients, believing in the rally as it has climbed a venerable stairway to heaven to 68.50 at the end of October. Up here, bears are trying to convince you that it is a misty mountaintop in the market. And while our work does suggest there can be more turbulence in November than in the last 6 months, with the possibility of retesting both the 50-day rising average and the 100-day moving average, our song remains the same at Oak Harvest. That is, it's been a V-bottom since April in a bull market, and V-bottoms historically don't give investors much of a buying opportunity for month 10 or 11. That the final celebration day in this glorious up move historically wouldn't come until we are higher into the first quarter of 2026, call it early February at 7,200 or higher. We've laid out this target and timing a multiple of times over the last 6 months, and many called it unrealistic for months. Now at 68.50-ish, it still seems like the market's destiny based on previous data is higher. Even now, with the markets trading above its 50-day moving average for over 125 days, bears are loud and many investors remain skeptical and hesitant. Just look at recent bearish AAII sentiment numbers. Bears decry we are overbought. However, the data and history says overbought can stay overbought for a longer time, and it's an indicator of market strength, not weakness. Here's the historical data on the rarity of the S&P 500 trading above its 50-day moving average for 125 days consecutively. Historically, 9 out of 10 times this has happened, the market has been positive with returns the next 3 months averaging 5.6%. A return of 5.6% from 68.40, our closing price as of this was written, would get you, yes, 7,200 in early February of next year. For now, regardless of what might be a November of chops, investors, our song remains the same, and we're still have a whole lot of love for the overall S&P 500 and for stocks into year-end and into early 2026. Investors know that regardless of the path for the economy and financial markets in the next few months, the investment team at Oak Harvest will be here.